As expected, the Federal Reserve is leaving its benchmark interest rate unchanged. This is a good indication that the previous 11 hikes are doing their job in slowing inflation. While there weren't any cuts Wednesday, Fed Chair Jerome Powell said during a press conference that a rate cut could be, quote, on the table at the central bank's next meeting in September. The Fed's decision means policymakers will hold the federal funds rate in a range between 5.25 to 5.5%. That's its highest level in 23 years. For more on this, I want to bring in Martin Baccardax. He's a senior editor and chief markets correspondent for TheStreet. Martin, it's good to be with you again. Some policy experts believe the Fed has already waited too long to cut rates, which has affected the lower and middle income part of the income scale. What's the consensus on that? Have they waited too long, or is that just one opinion among many?
I think it's the Coke versus Pepsi debate of financial markets right now, John, to be perfectly honest. There's a lot of discussion as to whether or not you can make the argument that they should have gone today, and whether you could make the argument that going in September makes no difference whatsoever. I think the balance of thought is that they may have left it a little bit too late, but they were so stung by the transitory inflation mistake that they made just after COVID, where they thought some of those price increases were going to recede very quickly, that I just think the Fed wants to be terribly careful right now, make absolutely sure that the data is moving sustainably in the direction that they want, and then they will move afterwards.
Martin, do you think that sense of care, which Jerome Powell demonstrates with every choice of the words that he uses, will extend to how large of a rate cut they might employ in September if they were to do that? In other words, a quarter, or could it go all the way to the half? Do we have a sense of what is on the table now that Powell has put it on the table?
Well, I think you're absolutely right to point to that, John. And I think it was interesting to me that Powell actually addressed that question almost directly in his press conference today with the media. He did say that 50 basis points wasn't something they were thinking about right now. In other words, they're probably going to want to lower rates by a quarter of a point each time, probably again to make sure that the data is moving in the right direction and that they don't move too quickly. But there is a sustainable part of the market right now, I should say a growing plurality, that thinks that the Fed might have to move more quickly and catch up as a result of them perhaps lingering a little bit too long. So I wouldn't take 50 off the table, but I was struck, and to your point, that he was less careful in addressing that than he might ordinarily have been.
And what has the market reaction been, to the extent that we can divine a unified reaction from market behavior? But how has this all been interpreted by the people who watch this like a hawk?
Reasonably bullish, I would have to say, John. And I wondered very quickly how that will play out into consumer lending markets as well. The benchmark U.S. Treasury bond yield, the 10-year maturity, is the one that most of us should look at to sort of discern where we're going to see changes in mortgage rates and credit cards and all sorts of other things. And that's moving sustainably and quickly lower now as a result of the messaging that we got from the Fed today. So I do think we'll see that play out in mortgage rates, and they certainly need a lot of help. It will be slower, I think, John, to filter into the broader consumer economy. And I think that's going to be the most concerning aspect for Fed officials and indeed politicians going into the election cycle, because we are still looking at food price inflation that's some 22% higher than it was prior to the pandemic. And I think this is very important, John, and hopefully you give me some rope here. Inflation is a rate of change and not a level. So even though inflation is slowing, that's a rate of change that is slowing rather than the level. The level of absolute prices is still much higher than it was, and that's having a significant impact on the economy, particularly now that Americans are seeing those pandemic-era savings recede as a result of, in part, those high prices.
And that rate's not, while the rate may slow, those price rises are, it's not so, it doesn't traditionally happen that then prices will suddenly go back down. So they're kind of at least stuck at where they were.
I think that's absolutely right. We are seeing some consumer pushback, and I think this is really important. McDonald's, for instance, introduced that $5 value meal just a few weeks ago. It sounds a bit funny, but it's really important. This is the biggest restaurant group in the world, and they actually saw increased traffic as a result. They had to introduce that meal deal because consumers were pushing back on high prices and not boycotting the restaurants, but they were seeing store traffic fall significantly. We're seeing that in Starbucks. We're seeing it in a lot of other companies. Costco had to wait 7 years to increase its membership fee because it didn't want to burden its customers with higher costs whilst they were also battling inflation. So I think that consumer pushback is causing some recession in terms of consumer prices, but you're absolutely right. It takes much longer than it does for the Fed to lower rates.
And unfortunately, we're out of time. But next time when we talk, we'll talk about the way in which those prices are operating differently for the people at the very top range versus the bottom, because the top is still spending like mad. But
you're absolutely right. The top is spending like mad because they're earning so much on their savings because rates are so high.
Precisely right. Martin Baccardax, always a pleasure with The Street. Thank you so much, Martin.
Thanks, Tom.